Welcome to a new era of insurance, where innovation meets necessity. Today, I'll guide you through how Insurtech is not just influencing our industry, but impacting it. Let's explore the tools, strategies, and innovations defining this moment. Despite of the investment decline, the impact of Insurtech is undeniable. With over $50 billion invested in Insurtech globally in the last 7 years, we could consider Insurtechs are truly becoming a critical part of the insurance transformation. The insurance industry is on the verge of major transformation, with 70% of industry leaders expecting significant changes in the next 3 to 5 years, according to our last CXO survey. The data is clear. 65% predict significant transformation while only 2% foresee minimal change, meaning standing still is not an option. To stay competitive, insurers must accelerate AI adoption, strengthen partnerships, and invest in scalable innovation. The pace of change is increasing, and those who embrace it will define the future of the industry. Another key driver is Insurtech's strategic shift toward profitability over hypergrowth. While some Insurtech players have seen impressive rebounds in the past year with Root plus X6 85%, Oscar plus 245%, or Lemonade Walsa 196%, the long-term picture tells a different story. Over 5 years, these same companies have faced significant declines, reflecting the industry's adjustments to market realities. The key takeaway? Sustainability now matters more than disruption. Insurtech that align with insurers' strategic priorities, leveraging AI, pricing optimization, or enhancing risks assessment will probably be the ones to thrive this new era. This trend is further validated by investment patterns among top insurers, where a substantial 50% of their startup investments are directed toward Insurtechs. This strong interest in collaboration highlights insurers' recognition of Insurtech as valuable partners in driving innovation and competitive advantage. So, while Insurtechs are emerging as pivotal drivers in the transformation of insurance, we've seen that their success is far from guaranteed. Strategic collaboration with insurers is crucial to fully realize their potential and maximize the value they bring to the industry. To keep analyzing the value of the Insurtech in the market transformation, we're going to divide it in 4 periods, from 2010 to 2015. Before the rise of Insurtech pioneers, insurers like AXA, Allianz, and State Farm invested heavily in building their own digital solutions. During this period, insurers invested around $2 billion in multi-year digital transformation initiatives, taking a DIY approach to modernize operations and strengthen their digital capabilities. Between 2015-2020, we saw the arrival of full-stack Insurtechs aiming to compete directly with incumbents through digital-first and AI-enhanced customer experiences. Companies like Lemonade, Root, Zhong-An, and Oscar collectively raised over $16 billion in venture funding, with each receiving upwards of $500 million. Their significant funding underscored the industry's pivot towards technology as a driving force for future transformation. In the next period, 2020-2024, the pandemic, along with favorable funding conditions, prompted a shift toward collaboration across the insurance ecosystem. In 2021, over 60% of top insurers entered partnerships or invested in Insurtechs, with half of their startup investments directed to this sector. This shift focused on modernizing core systems and expanding digital capabilities through partnerships rather than competition. This has been confirmed in our recent CXO survey conducted last February 2025, in which insurance leaders confirmed their diversified innovation strategies, prioritizing their in-house development but with an important percent dedicated to partnerships with tech titans, emerging as the dominant approaches, and Insurtech following. Looking ahead, emerging technologies like generative AI and quantum computing are set to redefine insurance processes and create new value opportunities. Insurers have a strong position to deploy these transformative technologies, but accelerating partnerships and investments will be essential to keep pace. While AI is already influencing digital transformation, its adoption is uneven. In P&C insurance, simpler and explainable algorithms are common, but in life insurance, only 24% of companies have adopted it. To fully capitalize on AI's potential, deeper adoption and advanced capabilities will be required. The future of insurance will be defined by emerging technologies, and industry leaders are already prioritizing where to focus. In our last survey, we can see Gen AI dominating with 65% of first-choice votes, signaling its transformative role in underwriting, claims automation, or customer experience. Pricing technology follows with 24% reflecting the need for more dynamic and data-driven risk assessment. And quantum computing, satellite data, or digital twins are on the radar, but their adoption is still emerging. But if we consider the true value of the Insurtech market, it goes beyond technology. It's fundamentally rethinking how insurance is delivered. To understand industry's transformation, we've identified 4 key market shifts that exemplify this change. The growing demand for hyper-personalization, the rise of distribution channels, the AI-driven underwriting, and finally, the acceleration of claims. But why these 4 shifts so pivotal? Today, approximately 85% of millennials, about 1.8 billion people, or 24% of the global population, prefer personalized insurance products that leverage real-time data. Furthermore, 67% are willing to share personal information in exchange for lower premiums. This trend is especially evident in the evolution of car insurance. Historically, car insurance premiums were often simplistic and inequitable, driven by static factors such as vehicle type, driver age, and claim history. This led insurers to struggle in accurately assessing risk, as broad generalizations could penalize safe drivers while inadvertently rewarding risky behavior, resulting in pricing inefficiencies and poor customer retention. Industry leaders like State Farm and Progressive, who leveraged more accurate data on driver demographics, regional risks, and complex regulations, managed to capture approximately 40% of the market share. In recent years, telematics has been a game changer, transforming the industry with data-driven models that allow insurers to track actual driving behavior. This innovation has paved the way for more personalized and equitable premium structures. For instance, Progressive, in collaboration with Insurtech partner Cambridge Mobile Telematics, expanded its Snapshot UBI program to 30 states by the end of 2023, covering around 50% of its $48 billion personal auto net written premiums. This program has achieved a 20% improvement in pricing accuracy compared to traditional methods, enhanced retention rates of up to 30% for telematics users versus traditional policy holders, and reduced claim settlement times by 15 to 20%. Looking ahead, we see that quantum computing and AI hold the potential to revolutionize risk assessment by processing massive datasets in real time. This includes not just driving behavior, but also external factors like weather conditions, road environments, and even driver health data. Such advancements could enable hyper-personalized policies that dynamically adapt to real-time risk factors. All stakeholders in the ecosystem, incumbents, emerging Insurtechs, and industry giants, are striving to gain the ability to predict future events such as accidents or breakdowns before they occur. This capability could become a true game changer, offering unprecedented flexibility and value to consumers. The second key market shift is the rise of distribution channels, particularly the significant role of digital channels. Our recent CXO survey revealed that 65% of insurers consider customer expectations for new digital experiences as the most pressing challenge currently facing the insurance industry. Embedded insurance is at the forefront of this transformation, exemplified by innovators like CoverGenius. For instance, CoverGenius helped a global online retailer boost add-on protection sales by an astonishing 513% in just 4 weeks. By seamlessly integrating insurance into the retailer's purchasing process, CoverGenius demonstrated that distribution doesn't need to be overt. It can be an integral part of everyday life. When we discuss embedded or invisible insurance, the concept of convenience comes to the forefront. By maximizing convenience, we can envision the concept of the always-on insurer. This model envisions insurance being seamlessly integrated into a fully interconnected digital ecosystem, powered by AI, IoT, and biometric data. A prime example is Ping An's home-based senior care program, which offers a comprehensive ecosystem that includes high-end retirement centers, online consultations with doctors and nurses, and life concierge services for daily living assistance. Their AI-powered system can also detect 13 behavioral risks, such as falls and poor air quality. By 2024, over 20 million Ping An Life customers had accessed these healthcare services, with 26 million employees served in 2023, establishing it as the largest always-on insurer. Moving forward, this model will provide proactive and autonomous coverage triggered without customer input, addressing the current protection gap. This shift is particularly relevant in light of the ongoing demographic transition with over 1.1 billion people aged 60 and above. Insurance will play a crucial role in shaping the future of the silver economy, ensuring that this growing population has the support and protection they need. The third market shift is AI-driven underwriting and claims, which can reduce processing time radically while enhancing pricing accuracy by 20% to 30%. In fact, AI automation and digital analytics have been identified as top priorities among insurers' executives to enhance risk assessment and compete with emerging companies. A notable example of competition is Next Insurance, which employs AI-based underwriting to serve small businesses, allowing it to issue policies in under 10 minutes. By analyzing data from multiple sources in real time, their AI models ensure accurate pricing based on business type, location, and industry risks. As a result, their underwriting loss ratio improved by 15% in 2023, delivering personalized coverage that aligns closely with customer needs and dramatically enhancing the customer experience. A standout example in 2024 is Lemonade's AI Gym, which set a world record by paying a claim in just 4 seconds. Lemonade is transforming the insurance landscape, with its AI agent automating 98% of first notifications of loss, cutting claim settlement times from weeks to seconds for over half of claims. Furthermore, this technology intelligently routes simpler claims that require a human touch to newer employees with the right skill set, while more complex losses are directed to seasoned experts. These capabilities exemplify the future of AI-driven efficiency. And now, can you feel the value of Insurtech? Thank you for your time and hope our recommendations are useful for you. Feel free to reach out if you need further assistance.